Good morning and welcome back to Almus Market Mornings. It's all eyes on Jackson Hole today with central bankers and economists gathering for the Fed's annual conference and Kevin Warsh set to give the opening remarks today. The big question is whether he gives markets any clearer signal on the economy, inflation, and the path back towards the Fed's 2% target. And closer to home, the rupee stayed relatively quiet yesterday, but gold kept us on our toes. And even though the government hasn't confirmed any cut in import duties, which we were discussing yesterday, the market seems to have started pricing it in, pushing MCX and domestic bullion prices lower, while international gold remained broadly steady yesterday. Good morning, Jayaram. So, what are the key areas we should be watching for in Warsh's remarks at the Jackson Hall today, starting at 7:30 p.m. IST?
Good morning, Ishan. Quite a few things, market is seeing. Um, you know, we had the PC core inflation a couple of days back, and it is well above 3%. And Kevin Warsh, in the last two meetings which he has headed, has said that the 2% inflation target for the Fed is non-negotiable, but he has failed to give any forward guidance on, which would indicate what Fed's plans are going forward. So it's going to be a credibility test for Kevin Warsh in the coming days, and the Jackson Hole will be definitely one of them, where his speech will be closely scrutinized. Any hints about near-term policy rate hike, which is very much justified after inflation has stayed above target for well over 65 months, would be seen as, affirming the market's expectations. Inflation has not only stalled at the elevated level, but is also seeing new pressures building with the AI investment boom, continued supply chain issue, and on oil, etc. It has beaten the transitory argument fair and square. Initially when the war started, they said this is going to end soon, and therefore the oil-related, uh, price pressures are going to end soon. But that has been proved wrong. Bond market particularly wants to hear that the Fed is not going to remain behind the curve forever. Any cues that point to delayed action would be taken as Fed becoming host to political pressure on monetary policy, and would be negative for the bond market as well. Now, what speech is also important in the context of the recent announcement by Treasury about doubling the quantum of long bond buying. So Warsh said that the bond market is doing Fed's job by tightening the financial conditions. On the other hand, Treasury is intervening to bring down the yields. So how you would reconcile the two is also something that we would look at. So clearly, his inflation fighting track record will be under the test. In the meantime, two more Fed members, Schmidt and Hammack, have given hawkish comment about monetary policy, and interestingly, they were not among the three dissenters at the last Fed meeting. As per report, Boston Fed President Susan Collins could also support a rate hike very soon. So this means that the hawkish numbers at the Fed is rising, and it is difficult to see how Warsh would be getting a consensus in the next meeting to hold rates. So the September rate hike, I would say, is still alive. Meanwhile, according to geopolitical experts' view, Russia and Ukraine war is likely to take a new turn, with Russia possibly targeting some NATO nation, even as Ukraine is expanding its strike against the Russian refineries. Export infrastructure, shipping, and other industries which are supporting Moscow's war effort. Meantime, for the markets, of course, the NVIDIA's forecast for revenue growth of 70% next year, being well above the expected estimate of around 52%, held Nasdaq soaring yesterday. Whether the market can ignore other headwinds like higher interest rates, geopolitical tensions, and trade wars just because of better guidance from NVIDIA is definitely questionable. Brent crude prices have jumped more than $2 a barrel on Thursday after a Wall Street Journal report said that US President is not interested in returning to the terms of memorandum understanding reached with Iran in June. Dollars has stayed, in a very range-bound manner ahead of the key event. But yes, as you said, gold saw some movement in both the local market and the international market. International market, it has seen some correction after a steep rise that we have seen in over the last 1 month, and the local market, of course, additional factor of rumors about duty cut on gold imports seems to have influenced the prices. But yes, I think these are volatile times for metals, definitely, and these news are adding to the volatility as well. For international gold, it looks like a 4,500 test can happen with any hawkish comment from the Fed chairman. But dips are likely to be bought by the market. Yen, of course, will remain the focus of the market as it stays shy of 160 levels, and whether any official action will come forth if it breaks 160 again is what we are looking at. Further out, we are looking at the employment data next week, starting with the jobs data on Tuesday. And of course, if the employment figures also come weak, it would complicate the situation for the Fed, because inflation is on the higher side, but the employment growth has been weaker in the last 2 months. So let's wait and see how this pans out. For the rupee, yes, I think the dip on Tuesday, the last trading day, was a bit uh, boon, or rather, I would say it was a gift for the importers, because they immediately bought into it yesterday, and there was a good demand right from the beginning of the day. But what caught my eye was the cost of swapping dollars for the weekend, or rather for the month end, soared to as high as 7.3% versus the normal 3%. There were quite a few reasons why this happened. Heavy dollar liquidity is with the banks, so who are actually mobilizing the FCINR-B deposits. Perhaps some of the banks had not swapped with the RB yet, and those long positions had to be swapped. The paying pressure was very high. FCINR scheme is closing on Monday. Means there would have been the last minute rush of deposits, increasing the dollar liquidity further. Market also running long dollar position for quite some time, and because the carry has been low, they have been carrying this position for some time. But sudden dip, and also the month-end pressure, which they had to roll it over, so that added to the paying pressure in the cash pot. Finally, the NDF market pressure also added to the paying pressure, because we had the the arbitrage between India market and the domestic market, which matured on the month end, also needed buying in the local market, which added to cash pot price. So a lot of focus was on the swap differences, and market was slightly taken aback by the steep rise, but that is due to special factors, and I think it should normalize. As far as the rupee is concerned, dips are going to be bought because oil is not sustaining its fall, and there are more uncertainties in the days ahead, as US policy also remains uncertain. Thank you.
Thank you, Jayaram, sir. And just to summarize, the PC core inflation is well above 3%, as we discussed, and the 2% target is a non-negotiable as per Warsh. So we'll have to see if any hints for any forward guidance is given. And of course, his credibility will definitely be tested at his opening statements today. And yields and the job to keep the rates in check is one of the themes we need to look for after all the treasury actions that were taken by Scott Bessent in the last week. Also, Russia-Ukraine is back in the picture as geopolitical experts are expecting some developments on that front. Coming to gold, it has seen some correction in the international market as well after a steep rise, and also in the domestic market yesterday morning, supported by the rumors for the custom duty change. And for international gold, 4,500 can be a target, but the dips in the middle being bought back by the market. Coming to the rupee, the dip on Tuesday was sort of a gift for importers to buy and cover their positions. But surprisingly, what took notice was that the cash pot was relatively high as compared to usual before the weekend, mainly due to the constrained dollar liquidity that we saw with the banks for the month-end demand. And this is because of the FCINR-B scheme also ending for the foreign flows by the end of this month. And also the arbitrage that we saw earlier this month between the bank and the exchange was also due to be unwinded yesterday. Thank you all so much for listening. Have a great weekend. I will catch up on Monday with the fresh run of updates. Thank you.